Stock Play of the Day Overtime is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day Overtime. On Tuesday's Stock Play of the Day, we looked at Chevron. Today we'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. On Tuesday's Stock Play of the Day, we talked about a deep in the money call option on Chevron. I'm currently highlighting the strategy inside the options playbook. It's actually featured in the Rookies Corners tab of the optionsplaybook.com website. And all that we were looking to do is a FOMO trade. Markets were choppy and a little scary. Warren Buffett actually was doing his swan song this weekend for Berkshire Hathaway, hosting his final shareholders event. At the mere age of 91, he's retiring. It's a little bit of a shame that he didn't start investing a little earlier so that he could have retired a little sooner. But now that he's 91, I hope that he can enjoy his retirement a little bit, going into his century birthday overall. So with that said, we bought a stock that he talked about in the shareholders meeting, and that was Chevron. Talked about the fact that they had owned some Chevron, stock went up, sold some Chevron, then bought some back at the beginning of the year. So we jumped on that bandwagon like a few of the other stocks. Those are basically the only stocks that seem to go up this week. And in Chevron, we went deep in the money. We went further out in time. And in this Rookies Corner tab, we talk about buying LEAPS calls. And LEAPS is just an acronym. It's just a fancy name for longer term options. And we didn't quite go out as far as a LEAP would be concerned. That's usually an option contract that goes out at least 9 months or more. We went out just over 100 days, and we bought an August option contract that acted a lot like the stock. And I like to build that always as a FOMO trade. Markets are a little choppy. I would like to buy this option contract just in case the markets do go up. And I also want to limit my risk on the downside. So it's literally a substitute for owning the stock. So we're going to buy an option contract that's going to act a lot like the stock, but not have all the risk that the stock does. And that's what we did in Chevron this week. So let's see how Chevron performed over the week. And 1 second here, I got to find the right chart. There it is, right where it was supposed to be. My bad. Okay, so here, in this instance, we have a 15-minute chart on Tuesday's Stock Play of the Day. We always tape it live, so we're always dealing with live markets. This is a 15-minute chart. This is noon on Tuesday Eastern time. That's when we tape the show. And we see that at noon, the stock was trading right around 162. By the end of the show, it was trading... about the same price. Then here's the rest of the day, a little choppy, closed right about where it started at the beginning of the show. Market ended up going all the way all day Wednesday, all day Thursday, up a bit, little bit of volatility in the stock price though. Marketplace was really struggling on Thursday, if you recall. And now we're back up at 168, a nice solid green bar in this last 15-minute scenario, looking for a new high over the week if we could get there. 168.57. So we're looking at about a 4% move in the stock to the upside when the rest of the marketplace is basically like the NASDAQ is it was down 4%, up 4%. Now it's down again. So a lot of volatility in the marketplace in general. All right. So on the stock play of the day, let's look at the trade that we looked at doing. So I'm going to run on over to the option chain. And if we scroll up, we see that Chevron right now is up 1.37% on the day. That's up $2.21. I'm going to run over to the dashboard, and we see that the SPX is actually down 0.25%. had a little bit of a bounce back from the open. And we see the NASDAQ is also right in that range. We see the VIX trading at around 31.61. And with that mentioned, I've always kind of talked about the VIX. When it was trading around 20, I really thought that was too low. I think the 30 is in the range. If we want to see some capitulation in the marketplace or a timing where you kind of shake out all the fear mongers out, I'd say somewhere around 40%. And I'm highlighting that actually in the VIX chart. Since the pandemic, we've only touched the 40% level a couple of times. So if we could get a little bit of that shakeout in the marketplace, that means that we would probably be down another 100 or so points in the SPX, right around that 4,000 level. We mentioned that on the show last week. Okay, so enough said about that. Overtime is all about how would we adjust our trade, and maybe we wouldn't adjust our trade if after the stock has had a few days to actually move. So if I go back to the option chains, I'm going to scroll down to our trade. So we looked at the August 19th expiration, 105 days are remaining in that. We bought the 140 strike call option. We basically bought that because the delta was right around 80. And I want to highlight now the delta is increased. It's right around 84. And that happens. The deeper you get in the money on the option contract, the more and more it starts acting like the stock. The most the delta could ever get would be 1. That means that it's moving 1 for 1 with the underlying stock as the underlying stock moves. And so in this instance, we looked at the actual price was about 26 at the midpoint. I think what we put in the rail was 25.95. We now see that it's trading at the midpoint. We'll call it 30. We'll give ourselves a penny or two. So if you're going 26 to 30, that's $4 over the last few days, if we just do a little bit of a roundup. So on a percentage basis, that's extremely well. But more importantly, if you were thinking about buying 100 shares of Chevron, we bought 1 call option as an alternative. Mentioned if you really want to get a little crazy, if you're thinking about buying 100 shares, maybe you buy 2 call options. But on a percentage basis, I like to look at, well, that was $4 or $400, but I would look at it on the percentage of monies that I was planning on spending on the stock. So still, it's very close to if we had bought the stock outright. Just because, as I mentioned, as the market goes up, you have on an option contract that's deep in the money, it starts acting more and more like the stock. We also mentioned that as the stock goes down, it starts acting less and less like the stock. You lose delta on the way down as it goes, as it becomes closer and closer to an at-the-money option contract. And that means that we would have a target level that if it got down to the 140 level, which was about, I think at that point in time, it was about 15% would have been the downturn. And then we just think about getting out. It's a natural place to get out. As that option comes down and becomes an at-the-money option, the delta is going to go towards 50, which means it's going to move slower and slower and slower. Time premium has time premium basically hangs out right at the at-the-money option contract. That's always where you're going to see the most time premium. And for example, I can highlight that because if we look at the 165, which is the most at-the-money option, the call option is a couple bucks in the money, but it's trading right around $12, $13. So there's a lot of time premium in that option contract on that at-the-money option. So if the market did come down, even though we paid $26 for it, you would expect it to trade somewhere close to these two levels, either around $13 or $10 on the ask price. All right. So that would be my stop point. That would be where I would be willing to get out. Now, as time erodes, time decay just dissipates, right? So if it moves down against you sooner and you decide to get out, you don't lose as much as you would if it happened later. And that's the biggest component of option contracts. But at this point in time, the market is up. So what would I do with this position? Well, one thing that we can do is very simple. Just go on out and sell it. Marketplace is a little rough, a little shaky, but energy has done well. Thank you, Mr. Buffett, for your little comments. And by the way, and I say this kind of flippantly because this is meant to be a paper trade. We're not, we're just trying to learn here on the stock play of the day overtime. And that's what it's all about. So I just want to emphasize that point. And our biggest thing that we try to accomplish here is that we have 40 different plays inside the options playbook. And I'm trying to find different market conditions where these plays might apply. We basically are getting rid of the theory that there's only one option trade that you can do, right? So we do butterflies sometimes that are advanced. We've done an iron condor. We talk about covered calls. And right now, we're just buying a deeper in the money option contract as an alternative for buying the stock outright, especially when it's a fairly expensive stock, like Chevron is, right around 167. So if we're going to close it, we just take the buy to open, which was our initial trade, and we switch that around and we'd say sell to close. You could target a little bit of upside. Maybe you do get to the highs of this week or so. So let's say we put a limit price in and let's put it in at 31. Why not, right? I would make that a good till canceled order, let it ride, see if it gets there, and then I'd be out. If that was my goal, if that's what I was looking for. We were looking at a little bit more of a longer term outlook on the underlying stock. So another alternative, well, the obvious alternative is you just stay in the position. You just let it ride for we went all the way out to August for a reason, right? We put some time into this trade because we were willing to be in this trade for some time. So we went out over 100 days. So if I go back, another alternative, and I mentioned it on the show, is to look at a fig leaf. And I don't think this would be a bad time to actually sell a call against it. When you're buying an in-the-money option contract, you buy more intrinsic value, real value, than you do time value, but you still have time premium in it. So one of the things that I'd like to do on a position where I bought it and have had a decent run up, especially a little bit in the near term, considering what's going on in the markets, is maybe sell a call option shorter term and create something that looks a lot like a covered call. We call it a fig leaf in the options playbook. It's also known as a leveraged covered call. I've heard people call it a synthetic covered call, which is the wrong name, flat out, because a synthetic position implies that you have the exact same risk, with carry costs and everything involved. And that's not true about a fig leaf. You don't have the exact same risk because you have limited known risk on the downside. At a lower price, then you have an obligation to sell it at. So you are covered as far as the brokerage firm is concerned. But the biggest thing is you don't own the stock. And if the stock gets called away from you on a fig leaf, you have to do something. So that's why we like to say you're kind of covered. And that's where we came up with the name for the fig leaf for the option strategy. All right, so let's look at a fig leaf. And this would be an alternative. And this is what the stock play of the day overtime is all about. So we're going to go back to the option chains. I'm going to remember this is your position. So I'm going to remove this and look at a strike that I might think about selling. And I'm going to give you a couple of rules if I'm thinking about a fig leaf as opposed to doing a covered call. If I own the stock, I'm willing to sell the stock at a higher price. I might think about selling the 177.50 call, another 7 points higher, or maybe even the 175 call. That would be fees. Well, I'm sorry, I should show you the expiration. 14 days away. We're only going to go up 14 days. May 20th, by the way, it's going to pay a dividend before that expiration, and it's a decent dividend in general. Okay, so if I look at this, I see the market at the 177 is trading right around, let's call it 120. I would lean towards the 180 or the 182.50. Here's why. It's a surrogate for the stock. We don't own the stock. We don't want to be assigned. So I'm going to give up premium and go further out in strike or further up in strike so that the risk of being assigned is a lot lower. And on top of it, we paid a lot less for the option than we did for the stock. So on a percentage basis, if we pull in 75 cents here, we're actually taking a good chunk of the time premium out of that option contract. And if I scroll back down to the 140 level, I can get a quick feel for time premium by looking at what the put is trading for, because a put is an out of the money option contract and it gives you a good feel for time value. It's not an exact science, but you're talking about $3.70 approximately in time value. So it would probably been a little bit more when we first put it on, which was on Tuesday. So we're going to take 75 cents of that away and make this thing like even more like the stock by selling it. Now, we don't want to be assigned. We have 14 days for that stock. We'd like it to stay under that level. And I guess we'll sell the 180. That'll be the official, I guess, paper trade this week, is to roll into a fig leaf. If we are long our position, maybe we look at doing this. And we don't want to be assigned. So I also have some homework for you. If you click on inside the options playbook, rolling short options. All right, I'm going to click on that. This is in the managing section. And this is an introduction to rolling a covered call, which obviously applies here because we're doing something that looks like a covered call, but isn't, a leverage covered call. And so we want to do an introduction to rolling. And this talks all about when you want to roll, when you would consider rolling. And this next page here, this next tab is rolling a covered call. And it's a very short read, but it just gives you things that you want to think about and be prepared to do if the stock over the next 14 days would get to that 82. Now, all that said, stock could go down. And if it does, this option gives you a little bit of a buffer. And on top of it, you can still sell your leap. You just have to buy the callback first, right? So I buy to close the callback, which should be at a lower price than where it was trading, right? Because the market went down. And then you would just sell your leap option. And you can keep your plan in place, however you would like to approach it. All right. Well, that's going to be it for this episode of Stock Play of the Day Overtime. Please click subscribe, ring the bell. Please follow me on Twitter. My handle is @BrianOverby. And I tweet about all of the stock plays of the days and other things that we do at Ally Invest. And I want to say thanks for coming, and we'll see you this coming up Tuesday for the next stock play of the day. Bye, everyone.